Hey everyone, welcome back to the channel. I'm Pablo, and today we're diving deep into low-cost index fund investing in 2024. If you're looking to maximize your returns while minimizing risk, you've come to the right place. Whether you're a seasoned investor or just starting out, understanding the do's and don'ts of index fund investing can make all the difference. We'll cover everything from researching the best funds to understanding the crucial impact of expense ratios. By the end of this video, you'll be equipped with the knowledge to make informed decisions and optimize your investment strategy. So, let's get started. Alright, let's kick things off with our first do research the index fund thoroughly before making any investment decisions. Start by understanding what the index fund comprises. Are you looking at a broad market index like the S&P 500 or a more specialized sector index? Knowing what you're investing in is the first step to making an informed decision. Take the time to look into the fund's performance history. While past performance isn't indicative of future results, it can give you a sense of how the fund has weathered various market conditions. Pay attention to long-term performance rather than short-term gains. This will help you gauge the fund's stability and reliability over time. Additionally, check out the fund manager's track record. A well-managed fund can make a significant difference in your returns. Look for managers with a history of outperforming their benchmarks. So, always stay vigilant and informed. Next, let's talk about one of the most overlooked aspects of index fund investing: expense ratios. Many investors make the mistake of ignoring these seemingly small fees, but over time, they can significantly impact your returns. Expense ratios are the annual fees that funds charge their investors, expressed as a percentage of your investment. Even a seemingly small difference of 0.5% can add up to thousands of dollars in lost returns over the long term. Always compare the expense ratios of different index funds before making a decision. Look for funds with low expense ratios, typically under 0.2%. Remember, every dollar saved on fees is a dollar that stays invested and grows over time. So don't overlook this critical factor. Always aim to minimize your costs to maximize your returns. Now, let's move on to diversification, one of the cornerstones of a sound investment strategy. Diversifying your investments means spreading your money across different asset classes and sectors to reduce risk. In the context of index funds, this could mean investing in a mix of stock indices, bond indices, and perhaps even international indices. When one asset class or sector underperforms, another may outperform, balancing out your overall portfolio performance. For instance, you might consider investing in both a broad market index fund like the S&P 500 and a bond index fund. This balanced approach can smooth out the ups and downs of your investment journey. Think of diversification as a safety net. It won't eliminate risk entirely, but it can significantly mitigate it. So, make sure your portfolio is well diversified to weather any financial storm that comes your way. One of the biggest mistakes investors make is chasing past performance. It's tempting to invest in a fund that has recently posted stellar returns, but this approach can be misleading. Past performance is not a reliable indicator of future results, and investing based solely on historical returns can lead to disappointment. Funds that have performed well in the past may have done so due to favorable market conditions that are unlikely to repeat. It's essential to look beyond past performance and consider other factors like the fund's strategy, expense ratio, and overall market conditions. Instead of chasing past performance, focus on long-term trends and the fund's alignment with your investment goals. Look for consistency and stability rather than short-term gains. Remember, investing is a marathon, not a sprint. This approach will help you build a more resilient and profitable portfolio over time. Let's talk about aligning your index fund investments with your personal goals. Understand what you want to achieve before investing. Are you saving for retirement, a house, or education? Each goal needs a different strategy. For long-term goals, consider higher risk for higher returns. Equity index funds like the S&P 500 could be suitable. For short-term goals, prefer stable investments like bond index funds. Your timeline is crucial. Choose index funds that align with your goals and timelines. This approach helps you stay on track and achieve your goals. Let's discuss a crucial but often overlooked aspect of index fund investing: tax implications. Taxes can significantly impact your returns, so it's essential to understand how they affect your investments. Different accounts like taxable brokerage accounts, IRAs, and 401ks have different tax treatments. In a taxable account, you may be subject to capital gains tax when you sell shares at a profit. Dividends and interest earned may also be taxable. Tax-advantaged accounts like IRAs and 401ks offer benefits to minimize tax liability. Some funds are designed to be more tax-efficient, generating fewer taxable events. Work with a tax advisor or financial planner to navigate tax-efficient investing. By planning for tax implications, you can maximize your after-tax returns and achieve your financial goals. Staying informed about market trends and economic indicators is another key aspect of successful index fund investing. While index funds are designed to be relatively hands-off investments, it's still important to be aware of the broader market environment and how it may impact your portfolio. For example, changes in interest rates, inflation, and economic growth can all influence the performance of different asset classes. By staying informed about these trends, you can make more informed decisions about when to buy, hold, or sell your index fund investments. There are many resources available to help you stay up to date on market trends, including financial news websites, newsletters, and market analysis tools. However, it's essential to strike a balance between staying informed and avoiding information overload. By keeping an eye on market trends and economic indicators, you can make more informed investment decisions and better position your portfolio for long-term success. One of the most critical pieces of advice for any investor is to avoid panic selling during market downturns. It's natural to feel anxious when you see your investments losing value, but reacting impulsively can lead to costly mistakes. Market downturns are a normal part of the investment cycle, and history has shown that markets eventually recover over time. When you panic sell, you lock in your losses and miss out on potential future gains. Instead, focus on the long-term perspective. During market downturns, it's essential to stay disciplined and stick to your investment strategy. If you have a well-diversified portfolio and a long-term investment horizon, you can ride out the market volatility and potentially come out stronger on the other side. Consider using market downturns as an opportunity to buy more shares at a lower price. By avoiding panic selling and maintaining a long-term perspective, you can navigate market downturns more effectively and stay on track to achieve your financial goals. Rebalancing your portfolio is an essential practice to maintain your desired asset allocation and manage risk. Over time, the performance of different asset classes can cause your portfolio to drift away from its original allocation. Regular rebalancing helps you stay aligned with your investment goals and risk tolerance. For example, if your target allocation is 60% stocks and 40% bonds, but the stock portion of your portfolio has grown to 70% due to market gains, it's time to rebalance. This involves selling some of your stock holdings and reinvesting the proceeds into bonds to restore your original allocation. The key is to have a systematic approach and stick to it. By rebalancing your portfolio, you ensure that you're not taking on more risk than you're comfortable with, and that your investments remain aligned with your financial goals. Finally, let's talk about the importance of having a clear investment plan. Investing without a plan is like setting out on a journey without a map. You need a roadmap to guide your decisions and keep you focused on your long-term goals. Your investment plan should outline your financial objectives, time horizon, risk tolerance, and asset allocation strategy. It should also include guidelines for how you will monitor and adjust your portfolio over time. Having a well-defined plan helps you stay disciplined and avoid making impulsive decisions based on short-term market movements. Regularly review and update your investment plan to ensure it remains aligned with your goals and circumstances. By having a clear plan in place, you'll be better equipped to navigate the complexities of index fund investing. This approach will help you achieve your financial objectives. Alright folks, that wraps up our guide to the top 10 do's and don'ts of low-cost index fund investing in 2024. We've covered a lot of ground today, from researching and diversifying your investments to understanding expense ratios and tax implications. Remember, the key to successful investing is staying informed, disciplined, and focused on your long-term goals. If you found this video helpful, please give it a thumbs up and leave a comment with your thoughts or any questions you might have. And don't forget to hit that subscribe button for more investment tips and strategies. Your support helps the channel grow and allows us to keep bringing you valuable content. Thank you so much for watching, and I'll see you in the next video.